This is known everywhere. And I think it's sad that retail investors are still catching on. They're still less than 1% of their allocations to gold. They're still highly in the 60-40 or some version of the 80-20 stock bond portfolio. And they're trying to figure this out. And platforms like yours and opinions like mine are certainly worth looking at. They don't have to take it at face value on the first watch, so to speak. But I think most of your clients, certainly our listeners, they've heard this before. They know this. They have the conviction. So again, the price moves month to month, week to week, day to day aren't really their main concern. And I'm not exaggerating. My partners and I and Egon, we don't really talk about the daily gold.
In contemporary financial discourse, one of the most striking realities, frequently emphasized by Matthew Piepenburg, is the persistent disconnect between institutional awareness and retail investor behavior. Despite widespread global recognition of gold's strategic relevance, retail portfolios continue to allocate less than 1% to this essential monetary asset. Many individual investors remain anchored to outdated portfolio models such as the 60-40 or 80-20 stock bond frameworks, even though these structures were designed for a radically different economic environment. According to Matthew Piepenburg, this adherence reflects not a lack of intelligence, but a lack of exposure to deeper macroeconomic understanding. Platforms offering independent analysis and alternative perspectives exist to broaden this awareness, not to impose conclusions. They serve as a gateway, enabling investors to examine long-term structural risks, question traditional assumptions, and make more informed decisions grounded in data rather than convention. Among more seasoned investors, however, the narrative is markedly different. These individuals have encountered the arguments around gold allocation repeatedly, studied decades of monetary policy cycles, and developed the conviction necessary to withstand market volatility without emotional reaction. Their investment philosophy prioritizes structural trends over temporary price movements, recognizing that daily or weekly fluctuations carry little significance in the broader context of currency debasement, debt expansion, and systemic financial instability. As Matthew Piepenburg often notes, conviction is not built overnight. It evolves through consistent exposure to evidence, disciplined research, and a willingness to detach from short-term market noise. This is why experienced investors remain steady even when the asset experiences pullbacks, understanding that volatility is simply a reflection of transitional phases within larger economic cycles. A defining feature of the approach taken by Matthew Piepenburg and his partners, including Egon von Greyers, is their deliberate refusal to engage in day-to-day price commentary. Their focus remains centered on long-term monetary realities rather than speculative movements. By concentrating on macroeconomic foundations, such as debt fragility, liquidity pressures, and currency dilution, they demonstrate that sustainable portfolio protection is achieved through strategic foresight, not reactive behavior. This professional detachment reinforces a crucial principle in wealth preservation. Resilience is built through clarity, discipline, and recognition of long-term systemic forces that transcend short-lived market fluctuations. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Yeah, again, we've been talking about gold for years, and certainly in the last few months when you see all-time highs, how many we've had this year, over 45, and then if there's a little bit of a pullback in the precious metals prices, silver or gold, there's a big concern. Have we reached peak gold in 2025? And then when gold gets back up again, those headlines dissipate. And I understand that, headline concern. I think for most of your viewers at this point who have a high conviction in precious metals, price movements in a bull market like this didn't dissuade them from their longer-term play and longer-term view on why you need to own precious metals. And I want to answer the question fairly without just, again, as always, suggesting just my conviction or bias. I've said many times, this is not an ordinary bull market. This is not an ordinary asset. This is a monetary metal, a precious metal. It's not even an ordinary commodity. It's not even an ordinary metal. And if you understand the context and why you originally bought gold and silver, which I hope was not just for immediate price appreciation to get rich, but because you understood and understand a systemic problem in the financial and the monetary system, not only in the US, but globally. And we'll talk about that. And I certainly would like to talk about silver too, more, because for a lot of investors, that's a more affordable way to understand this. But when Egon von Greyers started our company decades ago, it was with a long-term vision of many things, including banking risk and political risk and currency risk. But, there was a reason he was buying gold at those levels, and there was a reason he was holding it outside of the banking system, and there was a reason he would rather save in gold and silver than in dollars or euros or francs, or at the time, whatever, it was even pre-euro. It was simply because of an understanding of history and math and markets that the banks were risky, and we'll talk about banking risk, that holding your precious metals and your store of value, which is a better store of value than any paper currency outside of that banking system, made sense in 1995 and 2003, and it makes sense in 2025. If you understand these core issues, whether you bought gold at 1600 or 2800, or whether you buy gold when it gets to 5200, you'll still understand why you bought it. And I think the simple answer is you can't know the solution if you don't know the problem. And decades ago, Egon and many others, and myself later, understood the problem. And the problem, of course, as we've discussed in so many iterations, and we can bring out all the data, it's not just sensational, is we have a massive, unsustainable global debt crisis. It has been percolating pre and post-COVID. It's been percolating pre and post-2008. When you have a debt crisis, wherever your zip code is, whatever your central bank is, whether it's the ECB, the Bank of England, whether it's the Fed, central banks from Australia to DC will monetize that unsustainable debt with money created literally ex nihilo, out of nowhere, expanding credit, expanding the money supply, and debasing the currency. That's a very simplistic understanding of the problem, that currency will be debased over the long term. The inherent purchasing power of your paper currency, whatever currency that is, certainly the home of the world reserve currency is important. That whatever that currency is, it will lose its inherent purchasing power over time, as it has done, again, from ancient Rome to Philip II in Portugal in the 1500s, to the British Empire, the Dutch Empire, the U.S. Empire. Again, doesn't mean the end of all of these empires. Emphatically, Rome is still there, DC is still there, London is still there, but the purchasing power of those currencies and of those hegemonies inevitably debases itself because of the addiction to easy money and the addiction to debt to stay in power, whatever power that is, whether it's democracy or not. You need to spend. When you no longer have a chaperone to that money or that currency, whether it's a denarius or a dollar, you whittle away at the precious metal aspect, you decouple it from the gold standard, which is literally in Article 1 of our Constitution, and then you can go into greater debt, and that you can debase your currency. So again, simplistic historical lesson, but if you understand precious metals as a store of value, not a NVIDIA stock, not Anthropic, not a tech trade, not Tesla, whatever other asset that has made you rich or poor in the last 20 years, depending on your entries and exits, if you understand gold and silver as a better store of value to preserve your wealth against debased paper money, if gold goes down 10% in a 2-week period in these recent all-time highs, that doesn't bother you at all, because if you understand the problem, you have the conviction that this store of value, this silver or this gold that I own, is only going to go up further in a secular manner, not a straight line. It's only going to go up further in a secular manner because there is no immediate solution to the problem of debt. Again, we've talked about debt in 80 different ways, but it's nothing new throughout history. Sometimes history, again, is harder to see when you're in it. But no, as always with me, it's a long answer to a short question, but no, it is not a surprise to see gold going back up again. It will not be a surprise when it passes 4,800 or 5,000 or 6,000, only because this is not a bull market in precious metals. It is a bear market in paper money. You either believe that or you don't. You either accept that or you don't. We can spend a lot of time, and we have spent a lot of hours over the years talking about this. That's a personal choice. You should take your own informed judgment on that, but I think the evidence, which we can get into too, is fairly obvious that the world is catching on after decades of overextending debt levels to such a degree. It can be done for a while, but it's gone to that tipping point. It's like boiling water. It gets very hot for many, many minutes, and then at some point, it starts to boil. What we've seen since November of 24 and all of 25 is that boiling point has been reached. The water is now boiling. The awareness of the weakness of paper money in general and the world reserve currency in particular is now obvious, from the petrodollar to de-dollarization to the BIS to Morgan Stanley. The world is seeing this now, and I think retail investors sadly are the last to figure this out, because for decades they've been told by their private wealth managers or their online advisors or the RIA industrial complex that gold was just some pawn shop asset or precious metals were passé analog pet rocks, despite the fact that gold has outperformed in total return the S&P for a quarter of a century. Now that once intentionally misunderstood and ignored asset is making the headlines. Retail investors are starting to catch on that there's more to life than tech stocks or the S&P, and they're starting to ask why gold is rising.
The debate over whether gold has peaked in 2025 often reacts to short-term price swings, but the real story lies beyond the headlines. As Matthew Piepenburg explains, gold is not an ordinary commodity, it is a monetary metal intrinsically tied to the global financial system. Investors with a long-term perspective are rarely shaken by temporary pullbacks, understanding that decades of rising debt, persistent money printing, and weakening purchasing power create an environment in which gold thrives. When currencies lose value, the asset that cannot be created out of thin air becomes the most reliable store of wealth. This perspective is far from new. Thinkers like Egon von Greyerz have long warned that detaching currencies from tangible value breeds vulnerability. As governments borrow and central banks expand money supplies, currency debasement is inevitable. Matthew Piepenburg notes that this pattern repeats throughout history. Today, with central banks accumulating gold and nations questioning the dollar's dominance, gold's rise reflects a world confronting the long-term consequences of excessive debt and unchecked monetary expansion.
You need it. That explains why central banks now hold more gold than they do U.S. Treasuries. That sacred cow, that tier one asset of decades past, has now been replaced slowly but surely by physical gold. And we can look at the COMEX flows, and we can look at some of the wonky math, and we can look at the repo markets and the banking risks. But this isn't even a gold bug argument anymore, Elijah. This is known everywhere. And I think it's sad that retail investors are still catching on. They're still less than 1% of their allocations to gold. They're still highly in the 60-40 or some version of the 80-20 stock bond portfolio. And they're trying to figure this out. And platforms like yours and opinions like mine are certainly worth looking at. They don't have to take it at face value on the first watch, so to speak. But I think most of your clients, certainly our listeners, they've heard this before. They know this. They have the conviction. So again, the price moves month to month, week to week, day to day aren't really their main concern. And I'm not exaggerating. My partners and I and Egon, we don't really talk about the daily gold and silver price. We haven't talked about it for years because we just know with confidence that it will continue to move in a direction, again, never in a straight line, only because the situation in the global system, the global debt levels, is so empirically obvious now. And that whatever reset to come, whatever revaluation to come, whatever political mechanizations to come, from stablecoin to Doge to USA, whatever happens, we do know this. East and West, BRICS and the IMF, West and East, are looking more of gold, looking more at gold in particular, as really the new reserve strategic asset. That is a geopolitical, historical move. It is not a market move with a chart that you just need Bollinger Bands to follow to buy and sell. Because if you really understand gold, you'll hold it as a store of value, and it will be worth more in 10 years than a $10 bill in your pocket, regardless of where the price goes. In terms, it has a huge impact on liquidity in the markets. It has a huge impact on central bank solutions and more liquidity to come, which means it has a huge impact on the direction of gold and silver going forward. But again, and not to get too complex, the repo markets are places where basically commercial banks go to borrow from each other in overnight loans. And they post collateral for that overnight loan. And then the next day they pay back that loan at a rate called the repo rate, which is a little bit higher for the overnight lending, for the overnight borrowing. So the banks help each other out with liquidity. It can be large or small amounts. It's an overnight liquidity form. And it's very important to keeping the grease of the engine that is the commercial banking system running smoothly. And 99% of the time it runs very smoothly, like 99% of the time, hopefully new car run smoothly. But if you don't keep oil in that engine, no matter how good the car is, it will start to smoke and chuckle and choke. And eventually, if you don't put oil in at all, it'll blow up the engine. And if you think of the repo markets in the commercial banking system, that overnight loan, that overnight liquidity helps them keep the wheels of their lending and their operations greased. So those repo markets are important. And the rate for borrowing overnight is important. When that rate starts to spike, that means there's a low oil warning light. As I said in the article, there's a low oil warning light in the engine. So you need to put more oil in quickly. If you wait too long, it really blows up the engine. And what we've seen recently is that the SOFR rate, or the overnight repo rate, has started to go, the spread between that and the Fed's fund rate is getting higher. That means that there's a liquidity problem. The Fed is mandated to make sure that liquidity is there. It also means that these banks, among the too big to fail banks, are not trusting each other's collateral in the way they usually do 90% of the time or 99% of the time. Of course, the biggest implosion in the repo markets was in September of 2019 when the rates went up to 10% in a day. That was a major shock to the system. It cost hundreds of billions in immediate liquidity. And recently, a bunch of these primary dealers, these big banks, met at the New York Fed because there's a problem in the repo market. They're concerned that the rates have risen, these repo rates have risen, despite the fact that the Fed had just put in $125 billion prior to this. Again, without getting into the repo markets and then the emergency liquidity from the reverse repo markets, it's very simply saying that there's less and less liquidity in the banking system. There's less and less trust among the banks. There's less and less oil in the engine. That engine is so critical to the U.S. banking system, which is so critical to the global banking system, which is so critical to U.S. Treasury purchases, and so critical to derivatives trades, which are collateralized by U.S. Treasuries like the repo markets. I'm grossly simplifying, but you don't need to get into the complex to basically understand when you see repo rates surpassing the Fed funds rate, that's a sign that A, banks are losing trust, and B, there's a liquidity problem. And what that has to do with gold, of course, is to go to the reverse repo facility to bail out the repo markets, to bail out the banks that use those markets, is really just QE by another name. And so QE, of course, is printing money out of nowhere to provide liquidity. That's expansion of credit. That is indirectly an expansion of the money supply. Inflation is the measure of the expansion of the money supply. And when inflation, however it's misreported by the CPI scale, increases because of currency debasement through expansion of the money supply, that's usually and always a tailwind for an anti-fiat instrument like precious metals in general and gold and silver in particular. So these little tiny corners of the Wall Street world, which are the reverse repo markets and the repo market and the overnight markets, are again not on the water cooler conversations of your average conversation at work. It's not what you talk to your wife with a coffee at breakfast. It's usually not the first conversation at a football game or a golf outing, but it's there. It's ticking in plain sight, kind of hiding in plain sight. It's very much misunderstood, but the ripple effects of spiking repo rates can be very, very dangerous. And again, 2019 was an extreme example. We're not at those rates now, but the fact that we're there is no shock. We've had Powell trying to tighten the balance sheet all year, keeping rates low, but clearly, as of December, there's clearly a sign from the repo markets. It's on that dashboard of your car. It's a symptom that liquidity is tightening. When credit tightens in a world that is supported by easy credit or debt, when you start to see warning signs on the dashboard like that, this far into a debt cycle where we're literally at 38 trillion in public debt, where we're projected to have 50 billion. This Congressional Budget Office says 50 billion by 2033. When you see that kind of debt and that sustains us, and then credit markets tightening in those debt markets or lending tightening, and we see it in the subprime markets, we see it in private equity and private credit pools, we're seeing little symptoms all over the place of credit tightening in a world so enamored and so survivable by debt to see these type of warning lights, whether it's at the repo markets, and we can talk about the private equity markets, the private credit markets. This is not a good sign in an already world full of bad signs, from Main Street to Wall Street. So again, these simple little repo rates are a screaming indication that credit is tightening, liquidity is becoming drier. Boy, those are shark fins in a market sustained by debt like this. That's the simple answer.
Central banks are increasingly prioritizing gold over traditional Tier 1 assets like U.S. Treasuries, reflecting a strategic shift rather than a market trend. Yet retail investors remain largely underexposed, often less than 1% of their portfolios, while clinging to conventional stock bond allocations. Does this signal a broader lack of awareness or just inertia? Meanwhile, liquidity in the financial system shows warning signs. Repo and reverse repo markets, which lubricate the wheels of banking operations, are signaling tightening as spreads widen and trust between banks diminishes. These shifts are not trivial, they directly influence credit availability, market stability, and ultimately, the money supply. In such an environment, gold and silver emerge not merely as investment assets but as safeguards against systemic risk. Observing these structural dynamics highlights that long-term preservation of wealth depends less on daily price movements and more on understanding the broader financial ecosystem. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.